Imagine coming home on a normal Tuesday. You sort through the mail on the counter, and sitting there is a letter from your insurance company. You open it to find a notice of non-renewal. Your coverage is being canceled, not because you filed too many claims, but because the carrier has decided your zip code is now too risky to insure. Even if you avoid cancellation, the cost of keeping your coverage is surging. The average national homeowners insurance premium rose 21% in just 2 years. The math suggests this is only the beginning. Leading climate risk research groups project that up to 40 million American homes are on track to become uninsurable by the end of the decade. This creates a direct crisis for home values because virtually every mortgage lender in America requires insurance as a condition of the loan. Without coverage, a home becomes unmortgageable, effectively cutting off the pool of conventional buyers and locking the current owner into a property they can no longer easily sell. 5 massive financial and environmental pressures are currently breaking the underlying math of the insurance business. Weather events are hitting harder and more often. The sheer volume of storms wiping out entire neighborhoods means insurers are paying out a massive number of double loss claims that their original risk models never anticipated. At the same time, the cost to repair that damage has soared. Supply constraints on materials like lumber and copper, combined with a shortage of skilled labor, force insurers to pay market rates that far exceed the original construction price of the home. Then there's the global market. This diagram illustrates how local insurers buy their own catastrophic coverage, called reinsurance. As global reinsurance costs soar from disasters across the planet, those expenses pass straight down the chain to the homeowner's monthly premium. These factors are worsened by migration and litigation. Millions of Americans are moving into high-risk coastal and wildfire zones, while predatory legal loopholes, particularly in Florida, drain insurance reserves through endless inflated court battles. When these pressures multiply, the payout math collapses. To avoid corporate bankruptcy, insurance carriers are mathematically forced to abandon entire state markets. We are already seeing the exit of private coverage in the highest risk regions. Major national carriers like State Farm and Allstate have significantly reduced or completely halted new policies in wildfire corridors like California and hurricane zones in Florida. When private companies leave, the burden falls entirely on state-backed insurers of last resort. These safety net programs have suddenly swollen to absorb millions of abandoned policies, carrying a level of catastrophic financial exposure they were never designed to hold. This exposure is now moving inland. States like Colorado, Texas, and the broader Midwest are experiencing severe premium spikes due to an increase in intense hail and windstorms. The market failures currently paralyzing the coasts are an active preview of the financial reality approaching every zip code across the country. If your policy is canceled and you have a mortgage, a secondary trap triggers. Your loan contract legally grants the bank the right to purchase force-placed insurance on your property to protect their investment. Force-placed insurance protects the bank's financial interest. It does not cover your personal belongings or your liability, while routinely costing double or triple the price of a standard policy. The lender simply adds that fee to your monthly mortgage payment. This creates a downward economic cascade. When a zip code becomes uninsurable, new buyers cannot secure mortgages, demand evaporates, and property values fall. As home values decline, the municipal tax base shrinks. Cities lose revenue required to fund schools, roads, and infrastructure. This crisis directly dismantles the primary asset most American families rely on to build wealth. It is a structural shift in the real estate market itself. To defend your property, you need to audit your current policy today. Check your dwelling coverage limit and verify it matches the actual cost to rebuild your home at today's inflated labor and material rates, rather than the original price you paid. Next, identify percentage-based deductibles for specific disasters, like wind or hail. A 5% wind deductible on a $400,000 home means you are paying the first $20,000 out of pocket before the insurance company pays out anything. You also need to verify your flood coverage. Standard policies exclude flooding, yet roughly 40% of federal flood claims come from properties outside high-risk zones. Securing separate flood insurance is necessary even if you don't live near the coast. You can lower your risk profile by physically hardening your home. Installing hurricane clips or fire-resistant roofing materials often qualifies you for mandatory state insurance discounts, helping you to maintain your coverage eligibility. Finally, you must use an independent insurance agent to shop your policy across dozens of competing carriers every year. This is the only way to leverage market competition to your advantage. Individual homeowners cannot fix the macroeconomics of the insurance industry, but by understanding the real risks and taking aggressive action, you can shield your property and your wealth from the fallout.